Now that we have a firm understanding of the two phases of the market, the impulsive and the pullback phase, we can start to begin to understand trend basics and how it ties into market structure. Market structure is an important concept to understand in trading. It's going to help us understand the overall trend or direction of the market. And understanding this direction of the market will be the basis of how we build and plan for trades to ensure that we're trading with the market rather than against it. And simply put, that we're trading with the impulsive legs rather than the pullback legs. So ideally, we'll be trading impulsively with the market rather than in a pullback. So the markets are going to move in one of two directions: bullish, which is up, or bearish, which is down. Understanding which direction the market is moving is going to help you build higher probability trade ideas and help you capture trades that are in line with that impulsive phase. So let's take a look at the bullish trend or the uptrend in a market. A trend is bullish when we see a series of higher highs and higher lows forming in the markets. So in the most basic sense, the trend or the market is moving upwards. So in a bull trend, the ideal thing that we want to be looking for is buy positions, looking to trade the impulsive phases in the market. So if we take a look at what we talked about in the two phases of the market, we can see that the market is conceptualized between pullback phases and impulsive phases. And what we can see when we create a high in the market, we see a candlestick formation, a swing high, that then starts to initiate the pullback phase. And we can see that corrective counter trend movement to the downside in this case, because the market is moving to the upside. Once we put in a potential higher low in the market, we'll see price create some sort of candlestick swing formation in the form of a swing low, and that higher low is potentially forming in the market, and price will start to enter the impulsive phase and move towards the trend, or in this case upwards, to take out potentially the previous high. Once the previous high has been broken and a new higher high is formed, the cycle begins again where a new candle swing high formation will form, and we will start to see a pullback in the market. This new pullback phase will be initiated, trying to find a higher low to form inside of the market. We'll see another candle swing low formation form. And once that swing low formation holds or forms, we will then start to see price potentially forming a new impulsive leg in the market, which will then go on to break the previous high, forming a new higher high. And once more, once that higher high is put in the market, we'll see another swing high candle formation that will signify a new pullback phase in the market. The market will move counter trend to the overall bullish pro trend. And once a new higher low is formed in the market, we'll see some sort of candle swing low formation, and price will begin to trade higher, again, trying to break the previous swing high, forming a new impulsive leg in the market. And this will continue on and on and on as the market continues to trend bullish in this case. Now, what we can do is we can take it another step and basically reverse everything that I just said in a bullish market and apply it to a bearish market or a downtrend. A trend is bearish when the market is printing a series of lower lows and lower highs in the market. In the most basic sense, the market is moving downwards, and looking for sell positions in the bearish market is the best option. Again, we're going to be looking for taking trades or sells where we can capitalize on these impulsive movements to the downside. When we're seeing the market move to the downside and forming some sort of swing low, we'll see a candle swing low formation, which will initiate the pullback phase in the market. That will be that counter trend movement. So the up move in this case will start to form a swing high or our lower high. This will be initiated by a swing high candle formation. And once that swing high or that lower high in the market is printed, we'll start to create a new impulsive phase to form a new lower low, breaking the previous low And again, once that lower low is formed in the market, we'll see some sort of candle swing low formation, which will then initiate a new pullback phase in the market, where the market will move to the upside in that counter trend fashion to form a new lower high. The lower high will be formed when we see some sort of swing high candle formation. Once that swing high candle formation has formed in the market, we can then start to enter an impulsive leg in the market. And when that impulsive leg starts to begin, we'll see the previous lower low broken and a new lower low form. Again, once the lower low is formed, we'll see some sort of swing low candle formation, and price will enter that counter trend pullback phase. And this is going to continue on and on as long as the bearish trend exists. So very simply, a bullish trend is a series of higher highs and higher lows forming, the price is moving to the upside. And a bearish trend is a series of lower lows and lower highs where the market is moving to the downside.